Hi, this is Jiamin, investment analyst from PC Financial. At the start of this year, markets were optimistic and priced in a global economic recovery based on the premise that the rollout of mass vaccination programs will allow faster normalization of economic and commercial activities. However, the number of new coronavirus cases worsened in the last 2 months. The worst hit countries include Brazil and India. Reasons for the increase include the spread of new variants, pandemic fatigue, and the relaxation of social distancing measures. So how can this change of events impact on our investment portfolio? So on to equities. In the first quarter, we saw sector rotation as investors moved out from richly valued tech stocks and bought into value stocks and sectors that benefit from higher interest rates, such as banks. A new severe wave of infections may result in monies flowing back into tech stocks once more. As for high yield and emerging market bonds, the new wave of infections is currently severely affecting some emerging market countries. In our latest quarterly outlook, we have already expected divergent performance within the EM space. We recommend clients to stay selective on high yield and emerging market bonds and go for short duration. As for safe haven assets such as gold, as of 23rd April this year, spot gold has risen for 3 consecutive weeks as the dollar weakened. Also, the increase in COVID infections raised fears in investors and supported the demand for gold. Should the new wave of infections spiral out of control, we do not rule out the possibility of gold testing the psychological resistance level of US 1,800 per ounce in the near term. As for government bonds, the US 10-year Treasury yields have came off its peak in end March but remain near pre-pandemic levels as of 23rd April, as more than 30% of US adults are already fully vaccinated, and new infection rates in the US is not as severe as some countries. We do not expect government bond yields to fall significantly in the near term, unless the worst-case scenario materializes. That is, the US faces a new severe wave of infection. As for the US dollar did strengthen rapidly last year due to its nature as a safe haven asset. However, since then, the US have already passed a few massive stimulus packages and the Fed is not likely to hike interest rates soon. While the US dollar may gain strength further should the situation worsen, we don't expect the US dollar to be back at the same levels last seen in March 2020. With that, I end my presentation for today.